Hello, welcome to Fixed Next Gen Asia Pacific webinar on retail trading and how that's changing the face of institutional trading. We're excited to be able to do this by WebEx, which offers us much more opportunity than in person, although we all rather be in person, I think, but there you go. We've got 200 plus registered people for the webinar, so hopefully we can have a good discussion. And this is Fixed Next Gen. We want to encourage you guys to speak, to get involved. The topic was decided by the Fixed Next Gen guys and girls, and I think it's top of book at the moment in every newspaper, and we're all learning new words like meme stock I'd never heard of. I'd never heard of Reddit until fairly recently. We've all heard of Robinhood, I guess, but there's a whole new world of words and people trading from the retail environment. And just to put some colour into that, I read the other day that one of the big retail brokers says that one of its most asked topic on its chat site of a retail stockbroker was, what is the stock market? And the next best one was, what is the S&P 500? So there's a whole world of retail users out there that we've never seen before. If you look at Asia Pacific, from what I see in the industry here, we reckon there's about 170 million retail accounts in China accessing the markets, which is just staggering. And I think we reckoned in the last 5 years that's nearly doubled. We at the exchange see a huge growth in retail. And I think through the US, you see a huge growth in option trading, talking of 600% volume increases in option trading, which is spurred by retail. You've seen, obviously, the meme stocks and the 2,000% explosion. So I think it's added a completely different dynamic. So I'm sorry, I didn't introduce myself. I'm Chris from Hong Kong Exchange, and my co-chair of the Education Committee, who's going to take over from me now, is Damien. So let me pass over to Damien, and we can kick off the discussion. Damien.
Thank you, Chris. Hello, everyone. Lovely to be gathered again virtually for another Fix event. I'm just going to run through really quick a bit of housekeeping, something that we always like to mention at the top of these exchanges, whether virtual or in person. All Fix events operate under the principle of Chatham House rules. For those not familiar with that, essentially the spirit of the Chatham House rule is, to basically build an environment of trust, and one where we all are free and comfortable to share information, but with the caveat that any information you do receive or glean from today's presentation and discussion, that the sources are not revealed, or that the identities are sort of held anonymous unless you have prior consent. So not to say that you could not ask somebody for a quote, but if you were going to do that, we would ask that you seek consent from that person and their organization first. So thank you for that in advance. So now I think it would be appropriate to introduce our panelists. Moderating the discussion today, we are pleased to welcome Howie Zhang with Chi-X Australia, who is an FNG member and is going to be guiding our discussion today. And we also have on the panel James Andronis, Senior Specialist in the Market Supervision Division of ASIC, who is also going to be chiming in and sharing, I know, many views on this, I think, very interesting, very topical topic. So without further ado, gentlemen, thank you, and everyone for joining in. Howie, over to you.
Hi, everyone. A very warm welcome to all our Fixed Next Gen members joining us from around the region for our first FNG event for 2021. My name is Howie Zhang, and I'm very excited to be moderating today's panel discussion. First things first, I would like to keep this panel quite interactive, and so if any audience members has any questions, then please input it into your terminal, and I will direct this to the panelists. So the rise of retail trading in 2020 was well documented. In March of last year, as global markets plunged on pandemic fears, retail investors began piling in the market, sensing an opportunity at a time when many institutions were selling. This trend seems to have continued in 2021. The GameStop saga earlier this year has put retail trading front and center of the global conscious. Congressional hearings, media coverage, terms such as short squeeze, payment for order flow have all entered what seems to be the common vernacular. All around the world, retail trading seems to be still on the rise. Just last month, the latest Australian data shows that retail trading on the continuous market has reached a record 27.5%. Meanwhile, in the US, there's been increasing scrutiny on how institutions behave, and there's been signals that the regulator there is looking at market reform. Given how topical this subject is, my first question to our panelists is to ask whether you feel this change is permanent or temporary.
Thanks, Howie, and good afternoon, everybody. And thanks to Fix for allowing me to present today and talk about some of these issues. So, as Howie mentioned, we did see a step change in retail behaviour since COVID. It's funny to think that if you asked people back in March last year if we'd have about a doubling of retail participation in the market, most people would probably be surprised with that. What we saw is before COVID came around, retail levels were around 10%. They're roughly around sort of high teens to 20%, and Howie mentioned some sort of higher numbers there. But there has been a sort of doubling, if you like, of the retail share of the market. And we also saw accompanied with that was strong levels of account openings. And interestingly, there was a big surge back in March last year. Then things sort of quietened off a little, tapered off a little bit towards the middle of the year. They kicked up sort of September, October, quietened again, and then there was another kick up in January and February, and maybe that was because of a lot of the media attention around GameStop and other things. But also too, we find that a lot of people, when in Australia they're on holidays in January, they tend to think about portfolios and investing. They've got time to do it, probably talking to their friends and whatever, and that might spur some of the increased account openings as well. And I suppose we've got to look at why did this happen in the first place and what was driving it. So there's a number of factors that we can attribute it to. In the Australian market, you had a lot of residents, if they had a loss in income, were able to have early access to their compulsory superannuation. What that meant was in total about $37 billion was withdrawn from super, and some of that no doubt found its way into equity markets. Like many countries, we had income support payments being offered to residents who were affected by the pandemic. And you know, they were circa north of $100 billion, I think, and probably more than that. There was also people were locked down in parts of our country for quite a while, so that meant that they were not spending money on travel, and you know, Australians are prolific overseas travellers, and the borders were shut. They weren't spending money on entertaining or going out, and so they had surplus money. In a low interest rate environment, people are looking for a return on their money, so you know, the stock market presented one avenue for that. And some people too had been watching the market on the sidelines and saw the correction in March 2020 as an opportunity to buy and a value opportunity. So that was another factor. Then there was the boredom factor. So I mentioned about the lockdowns and that, but also, as you know, a lot of professional sports events were shut down, casinos were shut down in parts of the world. And that meant that those people who had an interest in gambling were denied those opportunities. So they would look for something else. And I think there's some famous well-known commentators in America who were sports bet commentators who migrated into share trading and brought their followers along for the ride, if you like. The other thing too is that there has been and everybody's familiar with the Robin Hood effect and the sort of democratization of share trading and zero cost brokerage in the US market, which also made less friction, obviously, in terms of wanting to buy and sell shares. It was a lot easier for people to do it. In Australia, we don't have payment for order flow rules, so we don't have free broking, but we do have some low cost brokers, so that made it easier for people to invest, and some Australian residents are investing directly into the US market too through some of the free brokerage offers that have been offered by some US broker dealers utilising that payment for order flow. And the other thing too, and I think Howie touched on this as well, or Chris did, about the media commentary. So there's a lot of media discussion about shares. There's a lot of social media chatter about shares and a lot of well-frequented sites as well. And all of these things increase the popularity of share investing. maybe it becomes something a bit trendy to do for people to get involved in, or fashionable, and so everybody gets on the bandwagon. And look, some people have made good money out of it as well. So, some have lost as well. But if people can see it as an opportunity to make money, that increases the attractiveness. So there are all the sort of factors, if you like, and you look at it and say, well, okay, are these things sustainable and whatever? Obviously, it'll be interesting to see what happens when government stimulus payments start to wane and get pulled back. Although you see, I mean, in the US, I think they just passed the $1 trillion US aid package, so the money's still flowing. Obviously, easier access to trading of equities will continue. It'll be interesting to see as the world starts to open up and vaccines take a hold, whether or not investors are still, retail investors are still prepared to approach the stock market with the same vigour, or if they have the same amount of time to do it, or do they actually spend their money on other things? As if we have a sectoral shift away from tech stocks, which seem to be quite popular with the younger generation, to industrial stocks and that, will they lose interest because they're not as fashionable or not as interesting to invest in potentially? And also if there's some sort of correction in the market, so we're not sure what event that might trigger that, but if there was, and if people lose money, they might say, well, this share thing is not quite for me, because, and you saw the experiences post the 87 crash and post the GFC, where there was a significant reduction in the level of trading by retail investors, despite a lot of exuberance in the lead up to those events. So, it was interesting because a lot of these things were commented in an article I saw this morning in the Financial Times, where they talk about the durability of this trading. And look, if it's 20% of our market and 30% odd of the US market, it's a sizable amount of trading and not something that's going to disappear quickly. And our view as a regulator, if people are making informed decisions and they understand risk and reward, it's not a bad thing that people are taking an interest in their financial future. It's just something different and probably growing more quickly than people had thought. So hopefully that answers that one, Howie.
Yeah, no, that was some really great responses. I mean, one of the things I want to comment is there was a slight divergence between the numbers you provided, 20%, and the numbers I sort of mentioned at the introduction, which is 27.5%. And I can explain where that deviation comes from. 27.5% is of the continuous market, so the trading between in Australia between the after the opening auction and before the closing auction, and retail tend to provide 90% plus of their flow into this continuous session. And so that's where my 27.5% number came from. But your 20% is, I believe, total trading. So including all the auctions and all the off-exchange trading, retail is 20%. But regardless, a very staggering amount. Yeah. I think one of the most interesting things that you touched on was, I think, and which was also related to sort of what we've seen go on in the US, is this idea that retail participants are using the stock market to gamble, and that's something that I guess as a regulator you could be potentially very concerned about, especially with the proliferation of new products to market that have either built-in leverage or can be quite sophisticated in their nature. And this, I guess, leads to a secondary discussion, is the rapid change of technological progress in terms of how retail investors are receiving financial advice. So whether that be on Reddit, whether that be on newer social media sites such as TikTok, how is the regulator sort of abreast of these developments?
Look, you touched on a lot of different issues there, Harry. We could talk for a while on all different ones. But okay, so how do we stay on top of it all? So obviously we engage with international regulators frequently, and we participate in IOSCO, which is the international group of regulators who come together to talk about these things. And as you'd appreciate, they're not immune to our market. These are global trends that we're seeing. So it's interesting to see what our global colleagues are doing and looking at. That said, obviously some of the regulatory settings are different in different markets, so you don't always get the same extent of some of the issues. We as part of our market supervision role, we do real-time equity market surveillance and derivative market surveillance. So part of that is trying to identify where there might be anomalies in share price movements or large moves in share prices that warrant further review. And then we look to see what is the source of that, what's driving the share price. Sometimes that may be due to, say, social media posts and things like that. So we have the ability to monitor those things. We're increasing our capacity to do automatic or electronic surveillance of some of those sites, and we're engaging with moderators of the sites as well to understand how they perform their role, particularly the sites that are sort of the more share-based sites, if you like. And obviously, we obviously keep a track on media developments, and we also get feedback from market entities. There's a lot of engagement we do with industry. There's obligations on market participants to report suspicious activity to us. So if they see unusual trading and things like that, they do that. So there's a whole range of tools that we use as a regulator. The other thing too, I think you mentioned about advice on social media and that. So obviously there are existing rules around if people are providing financial advice or financial service business, they need to be licensed. So we have groups in our licensing team and other financial advisory team looking at whether or not people are providing unlicensed financial advice, and we do take action where we identify that and looking to move sort of behaviour in the market, because as you say, a lot of people are getting information from social media sources, and if it's being provided on an unlicensed basis, a lot of the protection investors have around management of conflict and obligations on licensees are not there. So obviously we want to look at that. And the other thing too is obviously interested to see if there are any scams coming up. We've seen increased activity in that space, and we have a working group who looks at those issues and tries to intervene where appropriate. Obviously, in a low interest rate environment, there are products that are coming about which seek to exploit investors' bias for yield, and because people might be attracted to a headline yield number, they might not fully appreciate the risks involved with a particular product. So a lot of our role there is trying to find out what firms are disclosing to investors, what they're talking about in risks, how we're dealing with education as well of investors to make sure that they understand what they're buying.
Okay, thanks for that, James. I've got a question from an audience, and this question is more related to the Indian market, but given that ASIC is an Australian regulator, what if we generalize this a little bit and ask, well, how do you see institutions really catering to this increased retail trading? Has there been sort of an expansion of either products or a more permissive environment to allow retail trading access to the market?
Exactly sure what you're getting at there, but I mean, obviously institutions need to have a think about what all this change in retail investing actually means for market structure, price discovery, and the like, and particularly where you see stocks that may be driven on the back of social media trends or commentary, which may be disconnected from the fundamentals of the company. So obviously people need to be mindful of some of those issues as well, and see how they go there. But as I mentioned, because there is a low yield environment and there's a lot of new retail investors coming along, it's not necessarily institutions who are providing products, but we're seeing a lot of new products coming to market that are trying to capture some of this retail flow. So it might be new brokers who are trying to offer low cost models using an omnibus or pooled holder identification or HIN arrangement. You might be seeing fractional shares being offered to capture more investors. We're seeing copy trading starting to come back again. So it's more around product evolution or development. And so our role there is, with any of these products, is to understand the nature of the product, what the features are, what the potential risks might be, how they're disclosed and marketed to investors, and making sure that investors actually understand what it is that they're buying, and also too how do they fit within our existing licensing and other regulatory requirements as well.
Howie, can I just jump in there? Because I think one thing you will see, I think, with the institutions is that if you just looked at that GameStop, I think it was shorted 120% of the market cap at one point. I feel with what happened and what you see, and it happened again this week to an extent, you're not going to see hedge funds shorting such large positions, either in that unhedged or the derivative way that they did it, to the extent that they can leave themselves that exposed. I think that's really going to be the fundamental change you'll see from the short guys, right? They're not going to short 120% market cap, because it's kind of putting the red flag out for these guys, for their opponents to come in and start squeezing it. I think that will change.
I think the conversation has probably moved now to what has gone on in the United States, particularly in GameStop, and I would like, also related to this is what's brought this about, the rise of zero cost brokerage, the race to zero or to discounted brokerage around the globe. What kind of insights from the Australian regulator do you have viewing what is unfolding in the US on these topical issues? Things like naked short selling, zero cost brokerage, payment for order flow. How does the Australian regulator view this?
Yeah, look, I mean, there's a few differences there. I mean, obviously, we monitor what's going on in markets. And interestingly, we did see a stock in Australia called GME Resources, has the same ticker as GameStop, have about 900 new investors come on at the same time as the GameStop run up. So maybe some investors are a little bit confused about what the tickers were, which is concerning in its own right. But look, we have rules around restrictions on payment for order flow and payment order flow incentives in Australia, unlike the US. We were concerned around how conflicts are managed and how that might flow through the best execution. So we don't have free brokerage in our market. We don't have the same level of option trading that they have in the US. Our option trading tends to be larger stocks. I think in America there seems to be a much bigger level of option trading and leverage going on in particular stocks. We don't have the same level of short selling. I think the most we get short sold here in our reporting is around 15%. I think GameStop was allegedly 140% short from media reports. And we don't allow naked short selling in our market. So the rule is pretty much that you need to have covered short selling through some sort of stock lending arrangement. There's a few exceptions, but generally speaking, it needs to be covered. So also too, our regulator asks through our ability to take action for misleading and deceptive conduct or market manipulation, and also the ASIC probably taking a more proactive role in terms of intervening if there was extreme price movements by putting a company into trading halt. And I think there were some recent comments by the ASIC that indicated that they would look to do that. So when we look at all those things, we're not saying that it could never happen in our market, but we feel that the likelihood of that type of activity occurring in the Australian market is less likely.
Sure. When looking at sort of what has transpired in the US, I guess from Australian perspective, do you believe that there is a heightened risk to retail savings? Is there any evidence that the fiscal policy and monetary policy was being put into equity market or in the stock market? You did mention at the start that you saw that happening, but what kind of figures can be related to that?
Yeah, we don't know. I was just speculating that if there was that much money being pulled out of superannuation and from support payments, and then there was a corresponding increase in account openings and trading by retail investors on the market, you can draw your own conclusion to say, well, is there some connection? We don't know exactly where people spent that money. All we can see though is that from March onwards, when those payments started, was that there was a large uptick in account openings and trading volumes. And look, that may also be because the market had corrected 20% or whatever, so people might have seen it as a buying opportunity. So, I mean, our focus as a regulator, we want to make sure that we have confident and informed consumers, and that people have, and there's market integrity. So when people participate in the markets, they're seen as fair and reflections of supply and demand, that we have appropriate conduct by those people operating in the market and the like. And a lot of it with the retail investors. And I think it was Chris who made the comment earlier on that people are asking stockbrokers, what is the S&P 500? So obviously there's a big knowledge gap about, or lack of knowledge from some of the investors. They're just getting on a momentum trade. And so, part of our role is to make sure that people understand the risks, and it's a role that the industry has to play as well. And the media plays a role. A number of people play a role to try and highlight some of the potential risks, because as I said, we're not against investment. We want people to be actively involved with there and understand what they're doing. But the main thing is we want them to have knowledge about what they're doing. We want them to balance risk and reward. And some people, given their recent experience, might think that markets only go up. And we all know back in history, that's not always the case. So we just want to make sure that people understand that there is some risk and volatility. And you see that volatility. I mean, you have some talk in the States about inflation and interest rates possibly rising, and markets correct, quite rapidly. So it's just a learning exercise, particularly with a large number of new people coming on board.
So Howie, there's a stat from the States which says that 37% of people, retail investors in the States who are going to get their stimulus checks in March, which would account to about $170 billion, 37% of them have said they're putting that in the stock market. So that's about 170 billion going in. And there's another stat that says that in 1990, it was the average retail trader was a 50-year-old with $47,000 US, and today it's a 31-year-old with between $1,000 and $5,000. So the market's dynamics have massively changed. And I think there was a question that actually came in, I read a minute ago, saying, will this continue? This trend continue once COVID's over and the boredom factor disappears? And my personal view is I think much of it will. I think the danger, and James alluded to it, is when there's a massive crack in the market and everything corrects. What you've seen in history is retail kind of gets scared and it can go away for 3 to 5 years as it's scared of it. But I think this is such a big dynamic change with people playing around with smaller amounts of money that maybe that much more of it will actually stick, and they maybe don't get scared. But yeah, you generally see it disappear a little bit when the market cracks.
Do you feel that sort of the recent volatility and the recent opportunity that retail investors have seen has caused a much higher level of understanding and education about financial products? I mean, based on your anecdotal evidence about the number of questions related to what is the stock market, what is the S&P, it feels like this is an unprecedented surge in the total aggregate level of understanding about financial markets amongst retail investors, and that might cause longer term structural shifts.
I think that what I've seen at the exchange for the past 5 years, 5.5 years since I've been there, we've seen a huge growth in Chinese retail coming into us. And I know we're talking about this topic today, and it's been in the press end of last year and so on, but I don't think this is a thing that's just happened in the last 6 months. I think it's been exacerbated with the COVID and the boredom factor and all those kind of things. But I can remember looking at our Hang Seng index and thinking there was about 1% of that volume. So this is futures, not equities, right? 1% of that volume was probably Chinese retail. And today, and that within a few years had kind of gone to 15, 16, 17%. So that wasn't in the last year. That's happened right over the last 5 years. So I think that has shifted. In China, it's quite different because there's not many asset classes to invest in. I think in Australia, there's far more asset classes to invest in. But in the Chinese landscape, it's property and stocks, right? Or commodity futures or whatever they do. There's not the superannuation funds that you're blessed with in Australia and the mutual funds in the US and so I think there's a less choice. But I think I think we've also determined there's quite a lack of education, but that's probably where the institution side's struggling, right? Because not logic sometimes with it, and that's where the guys that are convinced this whatever company is going to go bust are suddenly, but they may be still right, but they're wildly wrong and lost their shirts. And I think that's the bit that the institutions are struggling with.
Mm. I mean, the ease of access in the market these days is also new and may also be contributing to this. I mean, we've got a question from the audience from Mark, and he says Superhero in Australia currently does $5 trades for equities and $0 or free for ETFs, but they own it under a unitized HIN. So these kind of innovations to get cheaper access to market by lowering the barriers to entry, presumably that's leading to less a lower hurdle to make these investment decisions. Sometimes they could be rash. What are your perspectives on sort of lowering these apparent costs of entry into the financial market?
I mean, look, obviously, if it's more efficient and less friction for people to transact, generally speaking, you think that would be a good thing. As you mentioned there, with some providers, though, they are using, and fractional shares use this as well. They use omnibus HIN arrangements. So that's a different way of holding, and some people post GFC would prefer to hold stock in a single HIN versus an omnibus HIN. So there are different risk profiles with those things, and investors need to understand that when they buy whatever product they're buying. So part of it is, what if you're buying a fraction, an omnibus HIN, a copy trading product, whatever it is. What we want investors to do is make sure that they understand what they're doing and understand what they're buying into, so they can make the right decision and see what's suitable for them. What we're seeing with some of the new providers as well is that what they're trying to do is to get people on a regular savings plan. So rather than the traditional model where you just say, I'm going to buy one share or one company or whatever, they're trying to get people to sign up and have a regular sort of like contribution. And so because of things like fractional shares and the like, you can actually get a sort of portfolio going where you basically just put every time you get paid, you put a couple $100 in or whatever, and see how you go. So that's something that's maybe slightly different. In the past, that was done through managed funds and superannuation and things like that. So this is another limb to that. So that's something to be mindful of as well. And then also too, you've got the growth in passive investing. Like, you look at the amount of money that went into passive. I think I saw some figure, correct me if I'm wrong, but it's like 700 billion or something went into ETFs in the States, I think, in last year, I think, or something like that. So very big numbers. And obviously that, and this is something that IOSCO has been looking at as well, the international regulators, is, at what point do ETFs and passive investing get where they may start to impact on things like price discovery and the like. So these are, things that have been subject to academic research and other things to look at some of these market structure issues. And then you overlay that with the growth in retail. If that's 20% in our market, call it, and 30% in the US market, that's obviously starting to change the market dynamics. So if you're an institutional investor in that market, and the other thing is, if some of those retail investors are driven by things other than purely fundamentals, and if you're a long only fund trying to work out which direction stocks are going to go, you maybe get it right for the longer term, but there could be some short-term volatility. So it's a tricky job, and and we've got probably some different market conditions than instos have probably been used to in the past, that they have to get their head around. So I'd be interested on your audience's views on how they manage those things as well.
I think to James's point, that regular saving thing is huge. I'm quite old, right? So I did this for my kids when they were born. So we're talking 25 years ago. I could find one provider in the UK at the time when I was there to actually take a regular direct debit. It was £25 a month for the kids to just put into this. It was a kind of global equity fund, and they charged, I think, £1 to do it, right? So the costs were fairly low, but there was one provider I could only find that could do that. Now, you can do it through most brokers, and this fractional things come in. And I think that's good. And I think that's the sticky stuff that will stay, and people will start to understand that dollar cost averaging is good, and you don't have to worry when the market cracks. It actually benefits you in your dollar cost averaging world, but people don't really understand that. The worrying stuff, I think, is the guy that's selling 50 call options short and doesn't really know what he's about to do or what he's done, right? That sort of stuff is where regulators and exchanges and clearinghouses and brokers need to be very careful.
Is there a sort of a reputational risk here for the entire industry, particularly the institutional side, where on the retail, risks, it could be said the risk appetite might be higher, but as and when, if and when things go wrong, then the whole industry is then put in some sort of doubt, which can feed through to regulators, can feed through to different players in the market. Is that something that James, on your side, is a consideration, or you just have to take the long-term view, let these things ride out, and politics will be politics?
It's a good point, Ed. And look, I mean, as I've said before, we want to make sure that we've got confident, informed consumers, and they have, there's market integrity and the like. And the risk is that if there was a correction and a lot of these new investors have a negative experience with the stock market, it can turn them off it for quite a while, and possibly a generation if they got wiped out. I'm not suggesting that's going to happen, but if that did, and if you look at post GFC, for example, there was a massive contraction in individual investment levels in the market post the 87 crash as well, so and other events. So because we've probably never seen the growth in the new and inexperienced investors like we have in more recent times, and so quickly, if there was that market correction, it could change their attitudes. Notwithstanding Chris's points about dollar cost averaging and things like that, people look at it and say, "I've lost a lot of my money." So we are, and this is a challenge for the industry too, because the other opportunity for the industry is if you've got all these new investors coming on board, if they have a positive experience, and you look after them right, and you don't engage with them appropriately and put them into the appropriate products, you can get clients for a very long period of time and build another viable source of capital. So we obviously are interested. We want to make sure that people have a positive experience and that they want to support our equity markets. And if you look at the experience in 2020, in Australia, there was over $50 billion Aussie raised by companies from the equity markets to support them during a tricky period, coming from predominantly institutional, but also from retail investors as well. So we do consider those things and look at those factors, and hence why we want to make sure that people understand what they're doing, that the product providers are giving them the right information, they're not engaging in misleading, deceptive conduct and the like.
Thank you, James. I think this is related to what you were just saying regarding deceptive and misleading conduct. Carol asked that if we saw GME type activity in an Australian stock, perhaps on an Australian website, how would ASIC respond? And then Tommy asks, is there going to be any major overhaul for retail investor education and protection going forward?
Okay, so on Carol's question then, so as I mentioned earlier, our market surveillance team would look at movements in a stock, and if you saw movements like that, we'd look to understand what was the cause. If the cause was social media posts and all that, we would then have a look to see, what was being posted, what was being said, and then obviously you need to assess how that stacks up against regulatory requirements. So was it market manipulation, pump and dump type activity, were there misleading and deceptive statements, et cetera, et cetera. So no different than it's no different than if people do it through a telephone or an email. It's just using a different format to do the poor conduct. So that's how we look at that. We just assess it in our usual way and refer it to our enforcement team, and they take action in the usual way. Is how we do it. And look, the other thing, as I mentioned too, is that and the ASIC has said this recently, that they would step in more quickly in the event of something like a GameStop type activity in our market as well. So for all the other reasons I mentioned earlier, it probably wouldn't get to the same extent. And Howie, the second question was about?
The second question was about overhaul of perhaps retail investor protection or education legislation.
Yeah, okay. So there's a few things we're doing in that front. We've got these product intervention powers. So where I think later this month, some restrictions are coming on CFDs around leverage requirements and incentives. We've also got a design and distribution obligation coming up in October this year, I believe, and that puts a greater onus on parties who are creating products and offering them to investors, and then they need to make a target market determination, make sure products are appropriate and the like. So there's a few regulatory changes coming in that space. We have a media unit who and our Money Smart website, which contains a lot of information around shares and share trading, and we constantly review that. And so as we see new issues and trends coming in the market, we can tailor our messages to suit. We have our commissioners and senior staff members out talking about the products to the media and industry and the like to make sure people understand the messages as well. So there's a number of different channels, and we also have a behavioural economics unit. So they look at a lot of and this is people talk about this gamification of trading as well. And I think there were some comments from FINRA overnight or fairly recently about, whether or not they see constant messaging from an app, whether or not that might actually be advice. And if it was advice, there'd be some obligations flowing off the back of that. So these are active issues for consideration, and they're being looked at by US regulators as well. We're thinking about them as well. And, how do you, this is a whole issue about, how are behavioural or psychological techniques being used to induce investors to either trade more than they would otherwise trade, or to trade in products that may not necessarily be suitable for them. So these are all issues that are under active consideration, and working out what things that we can do to have interventions to reduce harm to investors.
This recently, well, in the last 2 or 3 years, it seems that access to international products is becoming easier and easier, at least in Australia. In terms of what ASIC do you monitor or do you supervise the flow of funds offshore? And is there a concern that as you tighten regulations in Australia, for example, in tightening CFD leverage, that flow just leaks out to overseas jurisdictions?
There's always a risk of regulatory arbitrage, and people will move money around, and in a connected international economy, these things can happen fairly quickly. Having said that, I think we feel that we've got robust rules and a well-established system in our country that would be seen as a positive and attract investors, because we do have good structures and rule of law and all these sorts of things. So from an investor's point of view, these are all things that I'd want to be looking at and having confidence to invest my money into that market. But I hear your point. And what we have seen, and we saw this with GameStop as well, because some of the US broker dealers, as we know, stopped trading GameStop for a while, and we got a number of complaints from Australians who had invested through US broker dealers saying that they couldn't trade GameStop. Now, obviously, we've got to operate within our regulatory remit, and if somebody's going through an Australian channel, for example, but they're ultimately dealing with a US broker dealer, usually they've signed up terms and conditions with the US broker dealer. Those terms would usually talk about outages and whatever. And so they tend to be contractual matters or issues for US regulators to deal with around there. So it's a tricky one we talk to international regulators about matters and the like. But if somebody, it's like if somebody bought a property, for example, in another country, it's governed by the rules of that country. It's not governed by Australian rules, for example. So it's but it is a trend, and what we're hearing from the larger retail brokers is that more and more clients are actually looking to diversify and invest directly internationally. So before, they might have done it through an ETF, and there still is obviously a lot of action in ETF space. But people want to invest directly in the big names, so they hear the big international names and they say, I want to do it. And the friction, if you like, or the transaction costs of investing in that in those products has become lower. But again, from our point of view, people need to understand that they're a risk. If you're trading in a different time zone, when do you place your order? If you place an order in the middle of the night outside market hours, who knows what price you're going to get executed at? You've got FX risks you've got to deal with. You've got foreign tax laws you've got to consider. You've got rules of the market operators and things like that, which might be different than our market. So our role there is to try and educate people. And the other thing too, it's not just on us to educate. As I mentioned before, it's the media and that, but it's also industry. So a number of the participants actually do put education materials on their sites, and I saw one of the larger retail brokers recently put some information about international share trading and some of the risks and issues that clients should consider as well. So that's the sort of thing we'd like to see as well, because the intermediaries, if you like, are the ones who are receiving the orders and dealing with the clients. So that it's good that if they're taking a leading role to try and help educate their clients about particular products and the like as well.
I mean, you mentioned this concept of regulatory arbitrage and and investors seeking diversification from perhaps domestic assets. Now, I want to raise quite a controversial topic, which is the subject of cryptocurrencies, which they exist sort of to escape any form of regulation, and so I understand that this is quite a loaded topic, and you can perhaps talk a long time about this. But what is your view in how ASIC seeks to regulate cryptocurrencies? Is it a challenge, or is it sort of an unseen opportunity? And secondly, will we see blockchain technology being increasingly adapted in the Australian financial system?
No, that's fine. Although they're not really my areas, but I can give some comments. So we do have a team who does monitor developments in the crypto space. And look, as people will be aware, in the earlier days, there's concerns around the custody arrangements for cryptocurrencies and, who's actually holding the key. And if that's an individual and that individual disappears or passes on or whatever, there's been plenty of stories about people losing access to their Bitcoin. So, look, some of the changes in that space, and we're sort of looking at, in the market space, we're sort of looking at some of the changes in the market. So there's been recent reports about self-managed super funds buying into crypto in a bigger way as a sort of hedge against inflation instead of using something like gold, for example. We're hearing that, ETFs are being used more so in the States, for example, and, I think there was noise about them maybe coming to our market as well as another way of investing in crypto. And what that was doing, as I understand it, was that some of the institutions had restrictions in their mandates, so they couldn't invest directly in crypto, but they could invest in an exchange-traded product. So if you have an ETF which is investing in crypto, that seemed to be a way that institutions could invest in it as well. So we're obviously having crypto is there's a lot of debate amongst industry, and every day I hear something different coming out of one of the captains of industry from the States or whatever about the role of crypto and where it's going and all that, and whether or not a broker's opening up a crypto exchange or not. So not really my area, but it is another area that at ASIC we are looking at. And I think the other point you mentioned was about blockchain.
Yeah.
So obviously, ASX has talked about their blockchain transition for the chess replacement, and our market infrastructure team is looking at that closely and engages with ASX regularly to understand how that's progressing. And time will tell to see how those things pan out. And there's also a lot of discussion at the moment about how to use blockchain for capital raisings and transactions as well, because the hope is that it can reduce friction again and reduce costs and maybe shorten settlement timelines and things like that. So, as I said, not really my area, but these are all things that ASIC, other parts of ASIC are looking at, and there will be information on ASIC's website that talks about some of these issues as well if people are interested to have a look.
I mean, there is a third question that relates to this, and perhaps this is a question that's best directed to Chris or Ed. Which is there any relation or opportunity for FIX within the crypto or blockchain space?
think that's for Ed.
Well, I mean, yes, I mean, there is, as the fixed trading community, I guess just to back up a little bit, in terms of our membership, one of the unique things that I think about the fixed trading community is the breadth of membership. So you have, for example, James, as ASIC, our members. We have exchanges as members. We have, brokers, technology firms, all our members. So it gives us a very wide spectrum of input. That also includes a lot of technology firms that are very much involved in crypto, in the development of ideas, in the development of technology, and also, of course, looking for opportunities with the use of things like blockchain. So yes, we are involved as a community. There is actually a crypto currency or digital assets, I should say, digital assets working group. It's largely driven out of the States at the moment and is at this point quite technical. The other side of it is the education and marketing, which is sort of on Damien in Asia, Damien and Chris's sort of remit. And also I should say through the conferences that we do. So we are involved in terms of the actual protocol itself. That is, I think, being looked at. It is being developed at the moment. But in any initiative that is industry-led, it involves, having the right people participate. So I'm not going to pretend that progress is swift. It takes time. It depends on who is talking to and who is participating in those discussions. So, yeah, everything is there. But if, particularly from the Asia region, I think it's some of these discussions we need to, as a region, be feeding into more. So I guess the answer to your question, the short answer is yes, but we can be doing more.
And maybe just to state a bit of the obvious, but I'm dealing a lot with the proprietary trading, market making, high frequency guys around the world, but particularly in Asia. And they're obviously it crosses over nicely because they're obviously all in that space, or a lot of them are in that space. Some of the biggest players in the crypto space are the same people that are trading the ASX and trading Hong Kong Exchange and trading Chi-X and so on. So from a fixed perspective, it does cross over nicely, but then there's a whole fraternity outside of that as well who would not have naturally been a fixed client. So I think it crosses over quite nicely. It just extends further, if you want.
Mm. How do we see, I guess, you mentioned sort of this cross-regional competition for flow, perhaps. What can I guess jurisdictions do to better attract investment and flow? How can market structures be optimized even further? I mean, in the US, there is talk about market structure reform. There is talk about payment for order flow being revisited. I mean, where do we see the current regional market structure to exist? Are we happy to where it is, or do we think that there could be additional reform happening on the horizon?
Personally, I think if you look at the States, it's a very, very different landscape to what you've got. If we're talking with James in Australia and us in Hong Kong, I think they're very, very different landscapes. I mean, the fragmentation in the US causes additional problems that perhaps weren't ever envisaged when the idea of fragmentation or opening up for competition was there. Australia is a little bit quite different, right? There's obviously competition, but it all clears centrally. So I think what problems in different regions. I think the US, I think James says the payment for order flow in Australia is non-existent or not allowed. I think the same thing happens in the UK. It's not allowed. I think there's ways people work around it. Hong Kong, I don't believe they allow it. but it's allowed in the US, and there's, you know, people are now discussing, is it good, is it bad? So I think it will just evolve, but I think the changes will be quite different. And I think the most important thing, and we're endeared to James to be on this and actually speak freely, is that it's regulated well. Because if retail is protected as much as retail can be protected, then, like James said, they may, you know, that will grow. They may not get quite so scared away, and they are playing with big fish, right? Who've been doing this for years, who have kind of, I think Charles Lee used this phrase once, weapons of mass destruction that they understand and perhaps others don't understand. So I think the regulation of this is really, really important for retail. And hat off to ASIC for actually sitting there and telling us about it.
I mean, that is a pretty good point. James, do you have anything further to add?
Look, we have a market infrastructure team that constantly looks at all these market structure issues, and, you know, we've touched on the sort of blockchain thing as something that potentially could change how the market's structured. And I note too that if you talk about competition for capital and things like that, in the UK they've just released the Lord Hill report on listing review, suggesting a whole lot of changes to try and make their market more competitive for capital. And things like that as well. So, you know, there are other changes that we look at, and a whole range of issues. But you know, Chris is right. It's very important that we have integrity in our markets, and we feel that that's and you know, no doubt, Howie, working for a market operator there, is having liquidity and integrity in markets and good conduct in markets is probably the best advertisement that any market can have about attracting investors, and particularly. Australia being a net importer of capital, having done so for many decades, we you know, it's important that we have markets that are attractive globally for people to transact on.
And you know, in our conversations with our regulator, we can't change a piece of market structure just because it's good for said style of institution, right? The retail argument will come into that at the start. Is it good for retail? Does it hurt retail? Are you putting retail at disadvantage? Which is a good thing, yeah. Because perhaps even the retail brokers don't even have the voice that some of these large institutions have in the marketplace. And some of these, and I did laugh at, what do you call it? What was that other one you said in these days? I don't even know the names of the Superhero. I mean, it's fantastic. I don't even know the names of these guys. But not probably going to have a very large voice with a regulator, because the regulator may not even know, or they'll know who Superhero is, but, you know, they'll know the big institutions for sure, and they have a very large voice. But I know with our regulator, I'm sure it's the same in Australia, that every piece of market structure change has to be considered. You know, what does it do for retail? And if it disadvantages, then it's probably not going to happen.
Well, I think that's a really good question. James, from ASIC's perspective, what is the retail voice when it comes to, you know, these concerns or market structure? I know the institutions have, you know, very active desks that look specifically at market structure. With retail being such a massive part of the market these days, and if this change is sort of more permanent, do you see their space being for a retail body to emerge to sort of give voice for retail concerns?
Now, there already is. I mean, we have a few different channels. So, you know, there's obviously the industry channels. So we have AFMA, which tends to deal with institutional and larger firms more generally. We've got SAFER, which is the smaller mid-sized brokers, with some of the large ones in there as well. So the industry is represented. We do have a number of consumer groups and advocacy groups that raise issues. So there's the Australian Shareholders Association, for example. There's some of the industry funds. So from the investor side, they have industry bodies, ASIC, where they represent their interests as well. And then we have some independent groups who do research on what's going on in the marketplace and raising concerns and issues as needed. So I would say that they are fairly well represented, and we have, or more so, that we have good representation from a whole range of stakeholders, which is very important when you're coming up with policy and structural issues, and that's to consult broadly and listen to all points of view and try and come up with something that you think is going to be the fair and reasonable approach. But we obviously, there's only so much we can do as the regulator. It's a lot of these decisions are up to government to make a decision on policy and what they want to do, and so we've got to operate within that as well. But certainly retail have a voice. During the capital raisings last year, there was plenty of commentary about retail and how they were being looked after in capital raisings and the like. So and the other thing with retail investors too is that a lot of them are fairly vocal. They have good support in the media. They're more than happy to call up their local member in Parliament and express their concerns. So I think, I don't know how it operates in other countries, but I think here they seem to be well represented, and we listen to, as I said, a range of stakeholders in understanding how we execute our obligations under the ASIC Act.
Okay. If there's more questions from the audience, then I do invite you to ask them now, given we have about 15 minutes left in this discussion. If there is no questions, I would like to, I guess, ask. On one hand, during today's discussion, we've talked a lot about increasing retail protection, education. On another hand, the landscape for which retail have access to information and data is still very unequal. Do we try to, if we actively encourage retail investment in the market, do we also need to actively support the tools which they require to make informed decisions? So whether that be access to market data products or access to databases on which they can do research. Do you see any developments there in regards to enlarging the capabilities of retail investors?
Look, there already are a number of providers who give research services and other information to retail clients, and it depends what channel the retail clients come through. So some retail clients will come through a stockbroker, and they might be genuine retail clients who get personal advice from that stockbroker, or they might be high net worth clients who might just get general advice or just no advice and just do execution only, or they might trade on an online platform with no advice. They might come through a financial planner and get advice that way. So it really depends. There's a whole spectrum of the way that people come to the market and get advice. And the other thing too is that there are some of the brokers who might charge a little bit more for their service, but they might offer other services and say some of the discount price brokers. And so that's a choice for the individual to say, do I just want execution? Some of the low-cost brokers only allow you to place market orders, for example. And if you want to place a limit order, you might need to pay more money. If you want to get access to research, you might have to pay higher brokerage. And so these are choices that individuals need to make, like any service. And look, obviously, as part of that process of investors being informed of making decisions, part of that is about getting information and access to information. But as I said, there are a number of sources there, and it's up to the individual, I suppose, to decide. If they feel that they need some assistance and help, they might want to look at a provider who can give that service, and if that means they have to pay a little bit more, so be it. It's like doing a home renovation yourself, or paying a builder to come in and do it for you. If you want to save some money, take on the extra work. But maybe take on risk because you don't know what you're doing. Versus getting someone to do it, but pay a little bit more. So but yes, it's as I said, there are services in the market, and we do see some new services emerging. And I suspect what will happen is, like we've seen the emergence of a lot of these products, is people need advice and other things like that. It may be that you will see more products emerge in that space. The other thing too is that we've had some changes in the education environment for financial advisors and stockbrokers in our country that have been in place for a few years now, and there's a bit of a transition process going on in industry to get advisors up to a certain level of education and the like, and that's sort of playing out. And that's, again, it's not my area, but we're watching to see how that plays out in terms of what does that mean for the ability for clients to be able to obtain advice on reasonable terms as well.
I think there's an interesting point, Howie, about market data, which you mentioned. You mentioned market data. I don't know how Robinhood does it, but these retail guys, it's a different field from the institutional guys that, you know, free flowing market data coming through to their systems, automatically trading. The retail guys have somehow got to get that data, that market data, so the bid and offer.
But again, sorry, Chris, on that. Again, with some of the discount brokers, they might give you delays on getting quotes.
Is that what they're doing?
Whereas
Okay.
if you pay a premium service and subscription service and the like, it might be that you get real time, price quotes. So that's one issue. And I think some of the providers in the early days, they might give all clients access to that real time data. And then, after a free trial period or whatever, they might say, well, okay, you need to make a choice. Do you want the basic service or the premium? So they're just commercial considerations. And, as I said, investors can make a decision about, do they care about it or do they want certain features?
Yeah, there's been a growth of this snapshot as well that I see. I think we're doing it more with, we've had a massive retail broker come to us, doesn't want to pay a market data fee per user for obvious reasons because it's millions of users, but there's a snapshot feature that which I think is great for the retail guys to just push the button. It's charged on a per push basis. I don't know how Robinhood does it. If they're offering everything free, maybe they're not, but yeah, I mean, that's all consideration. I know from our perspective, we're changing, we're looking at the retail market like differently this year perhaps than we did 2 years ago, and how it can be dealt with from a data perspective.
I mean, turning to products, and this is, I guess, a little bit related, is that well, it seems like retail investors these days are looking for risk. They are participating in what at times seems to be quite speculative activity. I mean, from ASIC's perspective, are you sort of permitting this, or are you sort of looking at it and saying, trying to slow down that type of risk-seeking appetite? What is your view to if the market and the investor wants to seek risk? Do you allow more products to be developed to access that risk, or do you sort of gatekeep it a little bit and try to
that's a fair question. I mean, look, it's not our role to stop people investing or to stop product unless it falls foul of regulatory requirements. So if somebody's got a product and it's disclosures are fine and they've got whatever license they need or whatever and they're offering it, it's not up to us to say to people you can't buy shares and whatever. So it's a relatively free market in that sense. And look, not every retail investor is buying speculative stocks. So some of the data we looked at when we had a look at some of the buying that people did post March last year was a lot of them were buying top 20 stocks. A lot of them were buying dividend yielding stocks. Some of them were buying, and some of it depends on maybe the age demographic. Some are buying maybe more tech stocks or more fashionable stocks and the like. So like buy now, pay now later sector and things like that. But it wasn't all speculative. And so, there's always been in the Australian market, as far as I can remember, I've been dealing with markets for a long time, is that there's always been speculative money, whether or not it supports our emerging mining sector or whatever sector it is over time. So speculation is part and parcel of markets. Where we'd be interested, I mean, as I mentioned earlier, we just want to make sure that people know what they're doing, they're not being missold, they understand the relationship between risk and reward, and that in the event that they do lose money because there's volatility in a speculative stock that they've purchased, that they understand that they can lose money. So, we would be concerned if people were, putting all their money in one speculative stock and leveraging up to do it. But, if they're not getting, if it's a no advice order and they've just decided to do that, like somebody going down the casino and putting all their money on red or black on a blackjack table and on a roulette table, there's not much we can do to stop it. where we have some more hooks, if you like, is where advice is provided by a licensed entity in relation to that. And so then you can question the appropriateness of the advice, or did they do their KYC and AML assessments appropriately, or are there products being offered that are not properly disclosing the features of the product, or is there mis-selling when it's been marketed? So they're all the things we look at. But and this is why a lot of a big part of our role is to raise awareness of risks and issues with investors. And as I said earlier, it's good to see some of the participants in the retail brokers who are more active in this space also picking up their game and providing some education materials and helping their clients to empower them as well.
Okay. Well, I think we have only a few minutes left to go. If there is no further questions, then I would like to thank our panelists, Chris and James, for answering our questions today. It's been most insightful, and you can tell that there was such a wide diversity of questions, and no doubt that this trend or this phenomenon is still continuing. So very much appreciate your insights into this. Is there any final remarks that you would like to make, Ed?
No, I'd just like to as well say thank you to everybody involved, not least to yourself, Howie, for helping pull this all together, and to encourage people on this webinar for being involved, and really as a sort of a call to action. So Fix Next Gen is exactly that. We want to really encourage you to take the reins of this sort of discussions. So working with Howie, working with Barbara, with Chris and Damien and Sammy, let us know what you would like to hear. We would like to do more of these, but driven by you rather than certainly by the likes of myself. So please do get involved. And as a final thank you, thanks, James, very much.
Thanks, everybody, and thanks, Harry, for hosting the session. And always appreciate the opportunity to talk about the work that we're doing and the questions from the audience as well.
Excellent.
Thank you.
Thanks, Ed. Speak soon.
Okay. Bye.
Thank you.
Bye-bye.